Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Karen McCormick of Beringia to talk about the Proven VCTs. Firstly, Karen, tell me about Beringia and a bit of background about yourself.
Sure. Beringia is a transatlantic venture capital house. We've been investing for over 30 years. We have about $700 million under management across both offices. And in the UK, we operate the Proven VCTs.
And what about your own background?
Sure, I'm our Chief Investment Officer. I've been with the company for over a decade. I started my career in consulting and then P&L management, and now I've been an investor, as I said, for over a decade.
You've got two VCTs. What's the difference?
So the two VCTs both invest in the same companies and have the same underlying investment strategy. Traditionally, we fundraised on alternating years, which meant the allocations into investment companies might be slightly different. However, we've moved towards a 50-50 arrangement, so there's really no material difference between the two VCTs.
And what's their aim?
The VCTs aim to return a 5% tax-free dividend with an either stable or increasing net asset value, with occasional outsized returns when we have particularly good exit years.
So tell me about the types of companies you look to invest in.
Sure. So the VCTs invest in early stage growth companies. For us, that means not seed or startup businesses, but companies that have revenue. Generally, the revenue will be somewhere between $500,000 and $5 million at the time that we invest, although they could be larger. Generally, we're looking for businesses where we can see a strong route to profitability rather than just continued bridging of losses. We're a generalist investor, but we do have quite a strong footprint within the consumer industry. We also have a strong representation across software and SaaS. And then as a generalist investor, we also cover some other sectors such as healthcare, education, and fintech.
That's great, Karen. Do you want to just give me a few examples of some of the companies you've recently invested in?
Sure. We've had a really busy year this year. We've invested in over 8 businesses, but I'll talk through a couple of them. So one interesting business is called Astera, which is basically a satellite-enabled company that identifies infrastructure and water leakage. And this is an interesting business in part because the industry itself, so the identification of water leaks within specifically infrastructure, is still a very manual process today. And it's only because of satellite technology that Astera can now exist. So they're able to identify leakage from satellite technology without having to always go manually to actually identify a physical leak or wait until the leak springs up. Some other businesses we've invested in would include Moonshot, which is a business that is basically seeking out and helping to mitigate online harms, misinformation, and extremism. Another interesting business we've invested in is Dealroom, which is basically a data intelligence company for the early stage and startup ecosystem.
And what about some of the more established companies in the portfolio? How are they doing?
Sure. Some of our longer term investors will probably be familiar with companies like Monica Vinader, which is a highly successful jewelry business. They were impacted by the pandemic in that their retail shops effectively shut down. But the online transactions were more than making up for the retail losses, and so the business continued to grow and is doing very well. They now have a global footprint as well.
And any other examples?
Sure. Bliss is another business that's been in the portfolio for a while. They continue to grow very well. They're a media and advertising business. But additionally, as one of the more mature companies in the portfolio, they also have quite strong profitability. I'd also mention a couple of other businesses. MPB, which is basically high-end pre-owned camera equipment, closed a round of $70 million, led by Vitruvian in the past year. And then our portfolio company, Zuvu, has also experienced exceptional growth in the last year.
And what does Zuvu do?
Zuvu is also known as Smart Assistant, and it helps with online shopping. It provides basically guided shopping. So if you're looking for a high-tech product such as a laptop or a washing machine, it will help guide you to the right type of purchase.
So you've got lots of tech-enabled businesses. Does that mean the pandemic has generally been good for you?
The pandemic has generally, most of the portfolio have really done extremely well during the pandemic, and there have definitely been tailwinds for quite a few of the companies. We've certainly also seen some companies who had difficulties. So Fest Ticket is one of our portfolio companies that sells festival tickets and travel packages. They had to weather the storm for a little while, but I would say they're doing incredibly well right now as the entertainment industry rebounds, and there's a lot of pent-up demand for festival going.
And where do you get all your deals from?
Good question. We get our deals from pretty much anywhere we can, which includes professional introducers, so people like corporate finance houses or accountants or lawyers, but more often they tend to come from our own network. So that might be former entrepreneurs who have now become either non-execs or advisors who introduce companies they're working with to us, often other VCs, so we tend to co-invest with many VCs. Seed stage venture funds tend to provide us with kind of follow-ons and Series A. So really anywhere we can, and often direct as well, which a number of the companies that we did this year, we basically approach direct.
And when you look for an entrepreneur, what are you looking for? What's the strengths they need?
Sure. I don't have a magic formula, but some of the capabilities we look for. Drive is really important. Just core capability is also really important. An ability to build relationships, and then an element of humility. And the relationships is important in part because it represents the ability to attract the best talent in the market, which is very pertinent to all of the portfolio right now. It's probably the biggest single issue everyone's facing. I would say it also means that they can build relationships with potential acquirers and potential customers. And then those are really the characteristics we tend to look for in the founders, but across the team, we also want some deep expertise in the sector. And that can be brought in either through partners or employees or advisors.
And what value do you add?
We try to add value in quite a few ways. I mean, one of the things that's relatively unique to us is the US presence. So the ability to help companies commercialize into the US, whether that's providing funding or office space or introductions to accountants or customers. Additionally, we run the Beringia Academy, which is a monthly webinar that tackles different rotating issues. So it could be anything from hiring to how to go to market to building SaaS operations, so different specialty areas. We also have an in-house head of talent who helps portfolio companies with recruitment and retention. We have a head of communications who also spends time working with the portfolio companies on PR opportunities. And then we also have in-house legal who spends a lot of time with the portfolio.
And what about exits?
Sure, we've had 3 exits in the last year, including D3O, Contact Engine, and InSkin, which have delivered positive returns to the funds. And we also have a portfolio that in some ways is a bit mature now, so we would expect to have a series of strong exits over the coming years.
And how risky is it now?
How risky is it? That's a good question. I mean, early stage investing is always relatively risky. We try to mitigate some of that risk by the nature of the companies we invest in. They generally have revenue and we can see a path to profitability. For us, that means that our loss ratio is quite low. So certainly we wouldn't expect to write off more than one company a year, and even that is probably high. I think the elements of risk in the market right now are probably more to do with competition and pricing. There's a lot of money chasing the deals. There are a lot of deals, but again, there's a lot of money chasing the deals. So while deal flow is phenomenal, we're having to spend a lot of time trying to decide which companies we have really high conviction on and we're really willing to back.
And how's the VCTs performing?
Generally, the VCTs have performed very well. The net asset value is up about 13% year on year, and we expect to be able to continue to pay that 5% dividend, if not more.
And you've been at Beringia for 10 years. What do you think of the big opportunities are then in the future?
Oh, that's interesting. I mean, from a process perspective, we go through this process every year, and we've identified certain areas, like certainly healthcare and health tech is an interesting one for us. Future of work is quite an interesting one. Climate tech, ESG, those are hot areas. One of the things I would call out, though, is we go through this process every year and we go through a proactive outreach to the companies that look like the best performers in the areas that we think are going to be interesting. However, almost everyone does the same thing, and so those tend to be the areas that are most competitive and often most highly priced. So some of our best deals, we find, come from slightly counter-cyclical companies or businesses where we just found a brilliant management team, which might not fit into kind of our 3 or 4 year strategy in terms of areas that we're interested in.
Finally, Karen, if I'm going to put money into VCTs this year, why should I consider Proven?
Sure, I think the Proven VCTs have an extremely strong track record. We've been through many market cycles, and so we're really experienced investors. We also offer that unique US and UK connection, and these days pretty much every company has ambition to go to the US. So we find that our offering is probably more relevant and more valuable today than it ever has been before.
Karen McCormick of Beringia, thank you very much. Thank you.